Breaking news, mortgage rates increased again. Are they going to stop in 2023? Here's why mortgage rates are rising and how they negatively affect you. You might be thinking, how does this affect my dream home or my current mortgage? Those are great questions. Think of mortgage rates like gas prices, oil price hikes, production costs. They all affect the price. And in the case of mortgages, it's global economics, politics, bank profits, and even some mysterious they at the Federal Reserve have a say in the mortgage dance. This is why you should care. This affects your ability to buy a new home, sell your current home, and get a home equity line of credit. These rates affect buying power, total cost of home ownership, and your monthly payment. But don't sweat it. By the end of this short session, you'll understand what's driving these changes and what's next. And if you're wondering how to navigate this shift, stick around. First, let's truly grasp the truth about interest rates, how they affect home affordability that most people don't understand. This is the truth about inflation, how it affects your ability to buy a home. Inflation isn't just an economy thing. It's about your spending power, your monthly mortgage rates, your dream home's affordability. Inflation means buyers are now paying more for rent and mortgage payments, sometimes thousands of dollars per month. But who's behind this shift? The they, banks, policymakers, global events. They're the invisible hands pulling the strings, and sometimes they pull too hard. And here's what most people don't understand. For every 1% increase in interest rates, you lose 11% of your purchasing power. So stay with me because we're about to uncover how you are impacted by the combination of low inventory and high demand. Now quit watching your neighbors celebrate their new home and instead do this to get your new home too. Do you remember back in 2021 when home buyers were facing very few homes to buy, stiff competition, multiple offers, and paying more than list price without a second thought? This was due to the ultra low number of homes available for sale, homes lasting only a few days on the market, and high demand coming out of the pandemic that was fueled by artificially low interest rates. Today you have a golden opportunity that these buyers did not have. More homes to choose from, fewer multiple offers, more time to make an informed decision, and prices that are not blowing up every day. Now before I explain what you should do next, you need to understand how the Federal Reserve's actions influence mortgage rates and how you can use that to your advantage. Stop paying attention to social media and keep an eye on the Federal Reserve's actions instead. The Fed's main purpose is to control the flow of money to regulate the financial markets. They control the flow of money to banks by increasing or decreasing the interest rates that banks use to borrow money. And when the Fed lowers interest rates, it makes the cost of business cheaper for banks, and they can pass that savings to you in the form of lower interest rates. And when the Fed raises interest rates, the opposite happens. Banks pass those higher costs onto you by raising the rates on loans like mortgage and home equity lines of credit. Since then, the Fed has raised rates 10 times, including the most recent rate hike in July. This is when you can expect interest rates to start cooling down. The Fed has never raised rates so dramatically. Based on history, the Fed has typically waited too long to raise rates and then raise them too high, driving us into a recession. Since we are in uncharted waters, most economic experts expect the next recession is just around the corner. And when we enter the recession, the Fed will have no choice but to lower rates to stimulate the economy and get that ball rolling. And since housing is 20% of the GDP, this is where most people feel it first. In addition, when home sales start picking up, banks can afford to make less money on each mortgage due to the volume of business. And right now, the spread between the 10-year Treasury and the average 30-year mortgage is much higher than it was a few years ago. And as homes are sold, expect that spread to drop closer to 270 basis points or lower instead of the 300 basis points that you see today. Currently, you're paying about 0.5% higher due to the fewer home purchases and refinances. Banks need to pay their bills too. And this is not expected to happen overnight, but it will happen significantly faster than they raised rates because the country and our politicians in office cannot afford to stay in a recession for very long. If your agent isn't staying in touch with you now, it's likely because they don't know how to navigate this market. More than 600,000 agents across the country have never experienced a down market and don't know how to guide you through the treacherous waters into the promised land. They should be regularly paying attention to interest rates, keeping you informed, and telling you about special incentive programs available to you today that can alleviate some of the pressure on your monthly payment. That's what good advisors do. And if you're not getting this from your current agent, go find one that'll help you today and not just when the market turns around. And here's the two-step process to get the best price and have a mortgage payment that doesn't blow your budget. First, I recommend buying the best home you can afford today, as we do not expect prices to drop anytime soon. The only time prices have dropped across the US is when we've had a worldwide financial market meltdown like we did in 2008. The sooner you buy, the better price you'll have, because homes are still appreciating in most areas in the US. And then when rates drop, have your lender run numbers for you to see when it makes sense to refinance. Most of the time, it pays you to refinance when the rates drop about 1%. And this is the only way to lock in the price you want while getting the rate you want a few years down the road. And if you wait till rates drop, that pent-up demand is going to cause home prices to skyrocket, especially in the most popular areas. And this is the truth when rates will start to drop. If anyone tells you they know when rates will start to fall, they are lying. It totally depends on inflation and when the Fed's aggressive actions will cause the economy to go in reverse. According to a recent survey, economists give the US a 50% chance of a recession in the next 12 months. And based on pricing already in the market, most believe that rates will begin to drop in 2024, regardless of whether we have a recession or a soft landing. And since we've never had a soft landing and the Fed has never raised rates so aggressively, I tend to believe that we will face a recession sometime in the next year. So it's feasible that you could buy a home today and refinance to a much lower rate in the next 2 years. That's exactly what I recommend you do before you face stiff competition, multiple offers, and higher prices. If you liked the video, click the like button to let us know you enjoyed it. If you have any questions, leave them in the comment section below and I'll make sure to answer them. And be sure to hit the subscribe button and hit the bell so you never miss another episode. Take care and have a good day.